Okay, welcome to the top 5 charts of the week. This is where we go through this, and it's actually an article here that I posted on LinkedIn. See, that's me there, Callum Thomas. If you want to connect, feel free to do so. But anyway, this is what I send out to the email list of the website. This is the free email list. So if you want to receive that direct to your inbox, you can subscribe in the link in this video. Anyway, the purpose of this video is to go through these 5 charts, actually a little bit more than 5 this week, but we'll go through this 5 charts and add a little bit of extra comments and context just to bring a little bit of extra insight to the whole thing. So this first one here is global manufacturing PMI, so just bring it onto the screen. And we've got here the USA in the light blue line, global excluding US in the black line. Just one note on that, I haven't updated this for the February data yet. We don't have full results, but if you put the flash results in there, it would be below the line. I have updated the US figure there with the flash result. And anyway, the most stark thing about this chart, the most interesting thing about this chart is the gap between these two. Pretty much, we've seen this kind of gap before in recent history, and whenever you see gaps like this show up on kind of economic charts, even market charts, the understanding is that these kind of gaps are going to close. And in this situation, you have the gap is going to close by either one of two ways. Either USA catches down to rest of the world, or rest of the world catches back up. So we'll just briefly go through how that might happen. Well, first of all, I think probably the most interesting part about this chart is just to illustrate how unimmune America is to the rest of the world. I mean, back in the sort of 14, 15, 16 kind of softening of growth momentum, rest of the world went into kind of like a recession scare, and America just joined right on in. So the amount of interlinkages and the growing share and importance of the rest of the world, particularly the emerging markets, just can't be ignored. So that's kind of how that would play out. But I guess on the catch up side thing, well, one possibility is that this black line has actually gone down too far. There might be some sort of sentiment effects being wrapped up in that, so dissipation of that. But there is some definite softening of the actual activity data as well. So we can't fully discount that. The thing that does do though is it changes the game, or changes the calculus for policymakers. And already we've seen the ECB starting to actively think and talk about what they might be able to do in terms of stimulus, whether they do TLTROs or extend the low rates or whatever. The Bank of Japan's probably going to have to join that discussion if they're not already having that discussion. And of course China is the other big one, and probably the major one really. But we've obviously seen, last year global central banking was dominated by rate hikes. This year so far we've seen much more happening on the rate cut front, and certainly on hold is probably the most popular move right now for central banks. So anyway, this one, I just wanted to highlight this again. Really important chart, and definitely one to be watching as this gap closes one way or another. So chart number 2, or charts number 2A, B, C, D. So we've got US dollar index, couple of indexes that I've built myself, so equal weighted emerging market currency index based on 25 currencies, and an equal weighted Asian FX index based on 10 different currencies, and then USD CNY down here in the bottom right. That one is basically the most important one here, because the point that I was raising when I put in the comments here is that there is rumors or leaks or whatever you want to call them that a strong renminbi or Chinese yuan is going to be part of the US-China trade deal. Now, we don't have a deal yet, still getting there. A lot of if, buts and maybes, a lot of water to still go under the bridge, but it's looking possibly promising at this point. And if you have a strong renminbi as part of that, or at least stable, could be the straw that breaks the camel's back in terms of the US dollar looking like it's possibly peaked this cycle. And already if you look at Asian currencies, EMFX, especially Asian currencies, they bounced off that pretty critical support level there for the third time, broken up for that 200-day moving average. Same thing with emerging market currencies. I haven't got it here, but EMFX breadth has been powering up pretty significantly. So, that could be a very important catalyst here. I don't like to hang my hat on any one sort of event or, especially when it comes to politics. But when it lines up with something that's already underway, that makes it all the more interesting. Now this one is an interesting chart, kind of controversial because the margin debt year on year percent change, we're comparing that one against the level of the S&P 500, and if you looked at the year on year change in the S&P 500, it doesn't look too different from the margin debt one. It does look a little bit different, but not too different. I mean, some might argue that you could even just use the year-on-year change in the S&P 500 as your signal, but I think there's still some merit in looking at this. Certainly, at least from the point of view that it seems to have flagged the two major bear markets of the last couple of decades. It did give at least two, possibly three, depending on how things unfold from here. Two false signals, so where it's gone below the line and hasn't resulted in a bear market. Now, both of those situations, there was other things going on that kind of short-circuited the downturn, so there is that. The other thing is that in contrast to the big bear market signals, those two situations did not have the same kind of substantial acceleration before the plunge. So that's one thing that's also missing from the current experience, but certainly one to be mindful of. And speaking of margin debt, here's another view of margin debt. It's kind of interesting to have a look at this kind of thing alongside that previous chart. So what we've got here is an aggregation of net margin debt, so that's actually different from what we're looking at there. This is just total margin debt. This is the net view of margin debt. Net leveraged ETF, AUM, and net speculative futures positioning. And that's all standardized against the S&P 500 market cap. That's why it's a percent there. So you can see there's a little bit of deleveraging underway here following the market volatility. And that lines up with what we've seen here in terms of the fall. So, I mean, what is the takeaway from this chart? Well, first of all, margin debt or leverage bets is still pretty high in the scheme of things, at least over this period. So, there could be still a bit of more deleveraging to go before that thing is completely unwound. But yeah, basically it's a bit of extra sort of background information really. I guess you could look at this kind of chart like you would a valuation chart. High valuations are something that you see at the top of the market, but then high valuations can persist for quite some time. So it's add it to the mix alongside valuations, I guess, is the takeaway there. Now this last chart is one that has garnered a lot of attention. I think I first started talking about this chart maybe middle of last year, maybe earlier. I might do an updated blog post on this one and just dive into what's driving that a little bit. But since I posted it, a lot of other people started talking about it. It's appeared in a few publications even. And the reason why that is, of course, is because it's such just quite fascinating, really, how it went from, you know, in the 80s, early 80s, 90s, I mean late 80s, 90s, just fluctuated around this sort of 11 to 12% mark. That's why I said, you know, it's kind of this age of just say 11%. Then you had this sort of euphoria, earnings euphoria with the new economy concept emerging. And then of course 08, 09 we had the Great Recession where you know, sentiment changed quite a bit on the outlook, and sort of that period of stagnation, volatility, macro currents swirling across the post-GFC period, culminating in the secular stagnation theme, which was of course followed by the reflation theme, and then the tax cuts just drove that earnings hype bubble to very similar to what we saw actually during the dot-com new economy boom. And so I guess the you know, there's a few things to talk about with this chart. Firstly is that, you know, a lot of the time when you're talking about earnings estimates, yes, there's a bit of science that goes behind them, there's a bit of maths, but there's a bit of sentiment as well. And it does go to show how well, really how carried away things got on the earnings outlook there. And now we've started to see that sort of earnings hype bubble start to unwind. So it's definitely something to, again, this one's probably not something that's going to be a key part, you know, key thing to move the dial in terms of what you do in terms of investment strategy, but it's a good and important piece of background information like this margin debt one. So with that, I'll leave it there, and if you've got any comments or questions, do put them in the comments below, or get in touch. And indeed, if you wanted to receive this these top 5 charts of the week in your email box, do go ahead and subscribe to the mailing list.